The dust has not settled. In fact, the air is still thick with the smoke of burnt portfolios and the echoes of margin calls that rang out like gunshots over the weekend. If you are watching this, you are standing in the aftermath of one of the most violent, confusing, and psychologically damaging financial events in modern history. The trading session that just concluded was not merely a red day. It was a crime scene. It was a moment where the curtain was pulled back and the brutal, mechanical gears of the financial machine were exposed for everyone to see. We witnessed silver touch the heavens in the $120 range, only to be dragged down into the hell of the $70 range in a time frame that defies logic, reason, and fundamental economics. It was a gut punch. It was a betrayal. And for many of you, it was the moment you questioned everything you thought you knew about money, value, and the future. But I am here to tell you that what you saw on your screen was only half the story. In fact, it was the lying half. The red line that traced the collapse of your net worth was a digital fiction, a ghost story told by algorithms and leverage. The real story, the story that will define your financial future starting this week, was happening in the shadows. It was happening on the encrypted phone lines of bullion dealers. It was happening in the loading docks of refineries. It was happening in the arbitrage gap between Shanghai and New York. While the paper world was screaming that silver was worthless, the physical world was screaming that silver is priceless. We are standing on the precipice of a divergence so massive that it could snap the financial system in two, and what happens next week could surprise not just the retail investor, but the banking cartel itself. To understand where we are going, we must first perform an autopsy on where we have been. We need to dissect the great crash of early 2026, not with emotion, but with the cold, hard precision of a forensic accountant. What happened was not a market correction. A correction is when buyers and sellers agree that a price is too high and negotiate it lower. This was not a negotiation. This was a liquidation. It was a mechanical failure of the market structure. When silver went parabolic, it attracted a swarm of speculators. These were not the diamond-handed stackers who have been buying since $20. These were tourists. They were gamblers using borrowed money, betting on a sure thing. The market, in its infinite cruelty, sensed this leverage. It sensed the fragility of these positions, and like a predator culling the weak from the herd, it initiated a flush. All it took was a small push, a rumor, a dollar spike, a margin hike, and the dominoes began to fall. As the price dipped, the first wave of margin calls went out. Traders who couldn't post more cash were forcibly liquidated. Their sell orders hit the market, driving the price down further, which triggered the next wave of margin calls. It became a feedback loop of destruction, a doom loop. The price crashed not because the value of silver changed, but because the solvency of the holders changed. This is why the drop was so violent. It was not price discovery, it was forced selling. When a bank liquidates a client, they do not care about getting a good price. They do not care about technical support levels. They sell at market. They dump the inventory. This creates an air pocket, a vacuum where the price free falls because there are no buyers brave enough to step in front of the avalanche. We saw silver lose nearly 40% of its paper value in a blink. In any other asset class, this would be called a depression. In the manipulated world of precious metals, it is just a Tuesday. But here is the twist. Here is the secret that the red candles are hiding. While the paper price was collapsing, the physical market did not flinch. In fact, it tightened. We have reports from major wholesalers and dealers that as the price dropped, the phones started ringing off the hook. This was not panic selling from the retail public. This was panic buying. The smart money, the people who have been waiting for a pullback, saw this crash not as a disaster but as a gift. They stepped in and bought the dip with a ferocity that stunned the dealers. Usually when an asset crashes, the buyers disappear. They get scared. They wait for the dust to settle. But in silver, the opposite happened. The lower the price went, the more the physical metal disappeared. This created a paradox that exposes the fraud of the pricing mechanism. How can the price of an asset drop by $40 when the demand for that asset is increasing? It defies the basic laws of supply and demand. It proves beyond a shadow of a doubt that the spot price is not set by the physical trading of metal, but by the digital trading of contracts. We are seeing a bifurcation of reality. On one screen you have the spot price, which says silver is crashing. On the other screen you have the street price, the price you actually have to pay to get metal in your hand. And that price did not crash. The premiums exploded. Dealers, realizing that they could not replace their inventory at the paper price, widened their spreads. They disconnected from the matrix. They said, "We will not sell our real metal for your fake price." This is the beginning of the end for the paper market. When the physical market refuses to acknowledge the paper price, the game is over. The paper market becomes a theater of the absurd, a video game played by banks, while the real economy moves on without them. This brings us to the Shanghai signal. If you want to know the truth about silver, stop looking at New York and start looking at China. In Shanghai, the price of silver is trading at a massive premium to the price in New York and London. This is not a glitch. This is a scream. It is the market telling us that there is a shortage of metal in the East, and they are willing to pay up to get it. This price differential creates an arbitrage opportunity. Traders buy silver in the West where it is cheap and ship it to the East where it is expensive. This arbitrage is a giant sucking sound. It is draining the vaults of the COMEX and the LBMA. Every time the paper manipulators in the West smash the price down, they are effectively subsidizing the Chinese accumulation of silver. They are putting the strategic metal on sale for our geopolitical rivals. It is strategic suicide, and it cannot last. Eventually, the vaults in the West will run dry. There will be a failure to deliver. A major industrial user or a large investor will ask for their metal, and the vault operator will have to say, "I'm sorry, it's on a boat to Shanghai." When that happens, the price will not just rise, it will reset. It will gap up overnight. We will wake up one morning and silver will be up $50, then $100. The paper shorts will be annihilated. This is the surprise that is lurking in the shadows of next week. The market is coiled like a spring. The paper slam compressed the spring, but it did not break it. It only added potential energy to the system. The rebound, when it comes, will be equal and opposite to the crash. We must also talk about the circuit breakers. During the crash, many of you noticed something suspicious. The market fell, and yet trading was not halted. In the stock market, if the S&P 500 drops 7%, trading stops. It gives everyone a chance to breathe, to calm down. But in the silver market, the price plunged and the trading continued. Why? Because the circuit breakers are not there to protect you. They are there to protect the system. The clearinghouses, the entities that guarantee the trades, needed the liquidation to happen. They needed the weak hands to be flushed out to protect their own solvency. If they had stopped trading, the panic might have spread to the banks themselves. So they let it burn. They let the fire rage until it had consumed all the leverage in the system. This confirms that the market is rigged, not in the sense that the price is predetermined, but in the sense that the rules are applied selectively to benefit the house. You are playing in a casino where the dealer can change the rules in the middle of a hand. But even a rigged casino has limits. They cannot rig the geology. They cannot rig the industrial demand. This brings us to the copper connection. Silver is not just money. It is an industrial metal. It is the most conductive element in the universe. It is essential for the green energy transition, for the AI revolution, for the electrification of the world. and it is inextricably linked to copper. Copper is facing a structural deficit that is projected to last for decades. The world needs to rebuild its electrical grid, and there is not enough copper to do it. As the price of copper rises, it pulls silver up with it. You cannot have an electrified world without these two metals. The industrial demand for silver is inelastic. That means that factories need it regardless of the price. They cannot simply stop buying because the price is high, and they certainly won't stop buying because the price is low. In fact, the crash in price will likely accelerate industrial demand. Managers at major electronics firms and solar manufacturers are looking at these prices and licking their chops. They are locking in long-term supply contracts. They are draining the float. While investors are panic selling, industry is panic buying. This transfer of metal from weak speculative hands to strong industrial hands is the most bullish development possible. Speculators sell when the price drops. Industry consumes the metal, taking it off the market forever. So, what can we expect next week? We can expect volatility. Extreme, nauseating volatility. The market has been destabilized. The structures that held it in place have been shattered. We are entering a period of price discovery in the most violent sense of the term. The paper shorts will try to keep the price down. They will try to prove that the crash was legitimate. They will try to paint the charts with bearish patterns to scare away the remaining bulls. But the physical market will be fighting back. The premiums will act as a floor. If the paper price drops further, the premiums will simply rise higher, negating the drop. We are approaching a singularity where the paper price becomes irrelevant. If silver is $70 on the screen but you can't buy it for less than $100 in reality, then the price is $100. The screen is just a hallucination. The surprise next week could be a violent short squeeze. The entities that are short silver, the banks and the hedge funds, are playing a dangerous game. They're shorting a scarce asset in a physical shortage. If the sentiment turns, if a piece of news breaks, if the dollar wobbles, the rush to cover those shorts could be explosive. There is very little physical metal available to deliver against those contracts. If the holders of the contract stand for delivery, the shorts will be forced to bid the price up to infinity to entice sellers. We have seen this before. We saw it with nickel on the LME. We saw it with the Hunt brothers in 1980. But this time, it is global. It is not just a few speculators trying to corner the market. It is the entire industrial base of the global economy fighting for survival. It is sovereign nations fighting for monetary independence. The scale of the potential squeeze is unlike anything in history. You need to prepare yourself psychologically for what is coming. The market is going to try to shake you out. It is going to try to break your will. It is going to make you feel stupid for holding a barbarous relic. It is going to gaslight you. It will tell you that inflation is transitory, that the debt doesn't matter, that the dollar is king. You must ignore the noise. You must focus on the signal. The signal is the debt, $36 trillion and counting. The signal is the deficit, $2 trillion a year. The signal is the interest payments, more than the defense budget. The signal is the geopolitical fracturing of the world. The signal is the physical shortage of silver. These are the facts. Everything else is just sentiment and manipulation. Do not try to trade this market unless you are a professional. The volatility will eat you alive. If you use leverage, you will be liquidated. This is a market for the diamond hands. It is a market for the people who can buy an asset and sit on it for years, ignoring the daily fluctuations. It is a market for the people who understand that wealth is not measured in dollars, but in ounces. If you sold during the crash, I understand. The pain was real. The fear was real. But you fell into the trap. You sold your insurance policy while the house was burning because the insurance salesman told you the fire wasn't real. You need to get back in, but you need to do it carefully. Do not chase the green candles. Wait for the dips. Accumulate slowly. Rebuild your position. If you held through the crash, congratulations. You have passed the test. You have proven that you have the conviction to be a true stacker. You are now part of the remnant, the group of people who will carry wealth through the coming currency collapse. But do not get cocky. The war is not over. The volatility will continue. There will be more crashes. There will be more slams. You must remain vigilant. The great metals crash of 2026 will be studied for generations. It will be seen as the moment when the paper market finally lost control, the moment when the manipulation became so obvious, so egregious, that it broke the illusion of free markets. It will be seen as the turning point where the physical reality asserted its dominance. Next week, we could see the beginning of the recovery, but it won't be a straight line. It will be a battle, a grind. The shorts will not give up easily. They have deep pockets and the backing of the central banks, but they are fighting against gravity. They are fighting against geology. They are fighting against math. Eventually, they will lose. You need to decide which side of history you want to be on. Do you want to be on the side of the failing fiat currency, the bankrupt government, and the manipulative banks? Or do you want to be on the side of sound money, physical reality, and freedom? The choice is yours, but you have to make it now. You cannot wait until the price is back at 120. By then, it will be too late. The window of opportunity is closing. The physical metal is disappearing. The premiums are rising. The great divergence is here. Next week, the market is going to move. It is going to surprise many. Do not be one of the surprised. Be one of the prepared. Think about the psychological warfare that is being waged against you. The media, the banks, the government, they all have a vested interest in you holding paper assets. They need you to buy their bonds. They need you to stay in the stock market. They need you to believe in the dollar. When you buy silver, you are opting out of their system. You are going on strike. You are saying, I do not trust you. That is a dangerous act. And the empire is striking back. The crash was a punishment for your disobedience. It was an attempt to herd you back into the pen. But it failed. The physical buying proves it failed. The people are waking up. They are realizing that the emperor has no clothes and the dollar has no value. This realization is spreading like a virus. It is crossing borders. It is jumping from the retail investor to the institutional investor. We are seeing family offices, pension funds, and insurance companies starting to look at precious metals. They are realizing that the bond market is no longer a safe haven. They are realizing that the 60-40 portfolio is dead. They need a new hedge. And the only hedge left is the one that has worked for 5,000 years. When this institutional wall of money hits the silver market, the price will not just double or triple. It will go vertical. The silver market is too small to absorb even a fraction of the global bond market. It is like trying to pour the ocean into a teacup. The only way the market can clear is through a massive upward revaluation of the price. This is the surprise that John A.G. has been warning you about. It is the math event, the moment when the infinite demand for a safe haven meets the finite supply of physical metal. We are getting closer to that moment every day. The crash brought us closer. It shook out the weak hands who would have sold too early. Now the market is held by the strong. So as we look to next week, keep your eyes on the premiums. Keep your eyes on the Shanghai price. Keep your eyes on the delivery numbers. Ignore the spot price. It is a lie. Focus on the data that matters. The storm is not over. The boat is still rocking. But we know where we are going. We are going to the other side of the collapse. We are going to a world where money is real again. And in that world, the person who holds silver is king. The recent slam was a red alert, yes, but it was also a green light to stack, a green light to prepare, a green light to secure your future. Do not let the bastards grind you down. Do not let them steal your wealth. Stand your ground. Hold your position. The truth is on your side. And next week, the truth might just start to win. Remember the feeling of the gut punch. Remember the fear. Use it. Let it harden you. Let it make you more disciplined. The market is a teacher. It teaches harsh lessons. But if you learn them, you become unstoppable. The narrative is crumbling. The soft landing is a myth. The strong consumer is broke. The resilient banking system is insolvent. The cracks are everywhere. Silver is the caulk that fills the cracks. It is the glue that holds a portfolio together when the world falls apart. We are watching a controlled demolition of the global economy. The central banks are trying to manage the collapse. They are trying to inflate the debt away without causing hyperinflation. They are trying to suppress interest rates without destroying the currency. It is a tightrope walk, and they are drunk. They are going to fall. When they fall, you want to be standing on solid ground. You want to be standing on silver. So next week, when the market opens, be ready. Be ready for anything. Be ready for another slam. Be ready for a rocket launch. Be ready for confusion. But through it all, remember the fundamentals. Remember the physical reality. The paper game is ending. The physical game is forever. Survive the slam. Thrive in the recovery. This is the way. The surprise is not that silver will go up. We know that. The surprise is how fast, how violent, and how unstoppable it will be when the dam finally breaks, and the cracks in the dam are getting bigger every day. Watch the copper price. If copper starts to run, silver will follow. Watch the oil price. If energy costs rise, mining costs rise, and the floor for silver rises. Watch the bond yields. If yields spike, the system breaks and the Fed prints. If yields crash, the dollar dies and silver flies. All roads lead to the same destination. The destination is higher silver, much higher silver. The journey will be rough. You will get bruised. You will get scared. But you will get there if you hold on. Next week is just another mile marker on the road to freedom. Drive carefully. Keep your eyes on the road. And don't let the flashing lights in the rearview mirror distract you. We are almost home.